Happy Aloha Friday, everybody. It's Randy Hatada, broker for Xpand Realty, and we're here to address some of the issues and concerns that's going on in the housing world right now. But before we get there, we have a special guest in the room today. We have Vina from Xpand Realty, and we have Dax Tobin from Millennium Lending Group, is it?
Yes.
Here to join us in this show. And Dax is one of the experts in his field of lending, and hopefully he can help us answer some of these questions. But with that, Vina has always brought some light to the room, and today let's open with a nice little joke that you normally do, Vina.
Okay, I joined a dating site for arsonists.
And?
I've been getting a lot of matches lately.
All right. I hope you guys like that. She, we'll help her to come with the thunder. All right. Well, let's get started and let's just get the elephant out the room. What are consumers asking us about right now? What are they concerned about, Vina?
So buyers and sellers are really concerned about the Fed hike in interest rates right now. Can you tell me more about that? Should people really be concerned?
Everybody's freaking out because of it, right?
Yeah.
Well, that's why we have Dax in the room.
Okay.
It's probably your department, Dax.
Sure. Well, I'll say this. The Fed, when they hike interest rates, both in the short term and the long term, that will actually end up helping mortgage rates.
So that's contrarian to what everyone out there is, well, not everyone, but a lot of consumers are thinking.
Yeah.
Because once they hear Fed hiking interest rates, it's like, oh my God, my mortgage is going up.
Mm-hmm.
Right?
Well, yeah, that's true. Not all rates are created equal. So when the Fed hikes their interest rate, the interest rate that they control, it's a short-term rate. It's an overnight rate that they control the rate that banks can borrow money from the Fed at, and the rate that banks lend money to each other at, but just on an overnight basis. The Fed controls that rate so that they provide more or less liquidity to the market, and that helps accelerate demand in the market or decrease demand in the market, which would, in this case, they're trying to combat inflation by raising the interest rate.
Slow down inflation.
They're trying to slow down inflation. They're trying to slow down the economy, which would help with inflation. And if we bring down inflation, then ultimately that's going to help with long-term rates. We're talking about 30-year rates versus overnight rates, two completely different animals. So in
the lending world, we're talking about usually 15-year mortgages and 30-year mortgages.
Correct.
So that's what it's pertaining to as far as long-term, right?
Yeah. So the mortgage rates are tied more to inflation, because when you have an inflationary environment, a 30-year fixed mortgage is basically a 30-year bond. And when somebody goes out and they try to get when we're done with our mortgages, for example, we take those mortgages, they're packaged up, they're sold in bulk to Wall Street, for example, and people buy those as an investment. And when they get that investment, they get a fixed return. So that return may pay them, say, 3% or 4%. So let's just say that they earn a return of 3%. That return is 3% for the next 30 years on that bond. That's what that mortgage pays them back. So you can imagine if you're paid 3% return for the next 30 years when you purchase that investment, that bond, which is that mortgage. But let's just say now that over time, inflation eats into that. You have an inflationary rate of 6, 7, 8, 9, 10%. That 3% return is going to buy you less and less and less every single year. So that bond becomes worth less and less and less. So they have to, for the new bonds that are issued, the new mortgages that are issued, they have to charge more for those. They have to increase the rate to 4%, 5%, 6%. So that's what you've been seeing over the last 6 months. They have to charge a higher interest rate for those mortgages so that they can be competitive in an inflationary environment.
That's a pretty clear explanation. I've never heard it explained exactly like that. So thank you for doing that. So the way I hear it is like if someone invests in a bond and the inflation is more than what the bond's returning, you're not really making money in that aspect.
Well, yeah, I mean,
It's
it takes a
offsetting.
while for it to erode, it takes a while for it to erode, but yes. I mean, if you continue to earn only that 3% return, over time, you're not gonna be able to buy anything with that 3% return. So, it's very dangerous to your long-term return on those bonds. So that's why inflation has to get back into, under control. And when they get inflation under control by raising the short-term rate, which is what the Fed is doing, and they get inflation under control, they slow down the economy. That should help roll over long-term rates and bring those rates back down, and that's what they're trying to accomplish right now. Are they doing it effectively? Some people would say they're a little behind the curve on it, but eventually it will work.
Well, for anyone listening who is trying to kind of like define what inflation really is, it's basically the devaluation of the dollar, right?
It's this cost of services and goods are higher than they were yesterday and the day before. It's the two measures that most people take are CPI, a consumer price index, and PCE, product consumer expenditures. Those are the two most commonly used indexes for inflation. The CPI just hit 9.1%, and it's a 12-month rolling average of a basket of goods and services. So next month they'll take it'll be the August through August numbers, and July of last year will roll off. So every month that goes by, we're still just dropping off 1 month from last year. So we're going to continue to actually have pressure on that CPI number, I believe, all the way through the end of at the end of this year, because the housing numbers, for example, that go into CPI from July through the end of last year are still pretty good from last year. They didn't really start to really increase until the beginning of this year. So we still have some pressures on CPI that are not going to abate until the end of the year.
So I think the layman summary is that every dollar is buying us less goods and services, right?
Correct.
Right. So how do you feel about that, Vina? You're a realtor, you're with Xpand Realty, and you're in the field as well. Like, are you hearing interest rates starting to freak people out as soon as that media came out about the Fed's hiking it?
Yeah, I have had a lot of buyers like too scared to even just like browse right now. But how I explained it is that like next year the house is gonna appreciate, and you can always
hopefully
like yeah, and then you can always like go back and refinance. So.
Well, I'll let Dax hit on the interest rates and all that, but at the end of the day, that's really, to me, what's happening with our housing market is the fact that you have statements and economic situations that are being broadcasted by the news and the newspaper and by social media and whatnot. And as soon as we hear a rate hike, people start freaking out, and immediately I know the thinking is that mortgage rates are going up and I'm getting pushed out as a buyer, or things are going to get worse as a buyer. And as a seller, our sellers are starting to freak out because it's like, oh my God, mortgage rates are going up, we're going to get less buyers, maybe I have to reduce the price, or maybe I have to do something pretty drastic, or if it's not listed yet, maybe I have to sell. And that's why we have 4 times the amount of inventory we do today than we did a month ago. We went from a half a month supply, and right now we're over a 2-month supply. But rest assured, guys, that 2 month isn't that bad, 2-month supply of inventory, because a 3-month supply would still be a healthy market favoring the seller. In this case, there's a 2-month supply, and because of the volatility, the benefit to the buyers is really the buyers have the control right now, and the seller, they're kind of like, oh my goodness, what's happening? But on the flip side, I think what I'm seeing in the market is that buyers are like, I'm not sure what to do. I'm not sure how to react to this volatility. And so they're not doing anything. And what happens is that sellers start, emotionally getting worried. And then it leads to price reductions, which then lead to market reductions and our correction of the market in the housing side. Any input about?
Yeah, I think it's more about the speed at which everything has happened.
I'm surprised by how quick it happened. We kind of saw the writing on the wall that the correction was needed, but I mean, we just saw the change 2 weeks, like boom, and then we started correcting.
Well, that's true of everything in today's markets, whether the financial markets, the housing market. Things are just happening much, much faster than every cycle is much quicker than the last cycle, and the cycle before that. Today's world and today's markets, everything is accelerated. So I don't think this will be any different.
So what do you think what is happening with mortgage rates right now?
Well, they've, since the beginning of the year, they've risen almost three full percent. And, for them to go up that quickly, that much, it hasn't happened in a very, very long time. And so, people are trying to adjust to that type of meteoric rise. So, they will, and people will adjust to that level. Now, where will we end up? Where will we top out before things begin to roll over? It's tough to say. It's possible that we've already put in our highs for the year. They're aggressively raising rates on the low end. The Fed is to combat inflation, which will help that. They just did another a rate hike, 2 days ago. And if you look at a chart for mortgages, you'll see that immediately after the last 2 rate hikes of 75 basis points, which is 0.75%, mortgage rates immediately got better that day and the days immediately preceding.
So are you saying when the Fed raised it 0.75 of a point went down?
They did.
Because that is not what everybody's interpreting right now, and that is why I'm telling you.
It's fact.
Well, it's fact, which is what's relevant, but assumption is what really is affecting our market, because again, our buyers are thinking that hike increased mortgage rates, and they're right now trying to figure things out, and that's why we're here today.
Yeah. And people are concerned about that. They think, well, the Fed is going to continue to raise rates, and that's going to, when they think rates, they think all rates. Now, there is one rate that will go up related to mortgages when the Fed does increase their mortgage rate, and that is the prime rate, which is typically attached to home equity lines of credit. So that is a mortgage rate that will increase. So if you have a second a home equity line of credit, then that will increase. So you have to be watchful of that.
So in your industry, I know in our industry, we kind of see a slowdown in the fact, slowdown in sales, and we had 25% less sales year over year, and last month, and a lot has to do with the unknowns. I don't think it has to do with our buyers not being able to afford today's interest rates, because I've been in real estate quite a while, approaching 20 years, and in my career I've seen the boom in 2006, and your average interest rate was 6%, and that was a great deal at that time. And so, I feel like a lot of the buyers can afford 6%, but when it was 3% a few months ago, it's really hard to swallow that 6% because it ain't on sale anymore. So in essence, I think a lot of us and buyers, we're all spoiled in looking at the 2.5% and 3% mortgage rates. Is that accurate?
Yeah, I think that's exactly it. It's a comparison sell. So when they look at it and they say, well, I could have bought this house 5 months ago and had a rate of 3.25%, and now I'm looking at 5.75% or 5.875%. It's difficult for them to adjust to that. So over time, that adjustment becomes easier, and that's the new reality of where rates are at, and people will start to filter back into the market because they realize they have to buy a house for whatever reason. People get married, people get divorced, people move into town. There are reasons that people need to move. They need to buy a home. They're downsizing, whatever the case may be. So they'll take the rate that is available at that time, and that doesn't mean necessarily you buy your home. People say, well, it's a 30-year mortgage. That doesn't mean you're going to keep that mortgage for 30 years.
Most people don't, especially in
over the last, if you look at the average length that a person keeps a mortgage, it changes over time based on the market cycle that we're in and everything else. But in my experience, I mean, over the last 10 years, my average client has refinanced their home 3 or 4 times. So, when we get into the next cycle and rates do come back down, which they will eventually, will it be next year or the year after? I don't know for sure. I suspect that they will come back down, and they'll come back down pretty sharply. And when they do, people who have our interest rate right now, in the high 5s, when they close on their home, will they be able to refinance down into the 4s and the 3s again? At some point, yes, they will be able to, and then
You
they'll
think
end
we're
up
gonna
with a
hit
lower
those numbers again one day?
I do believe that we will. Yeah.
Wow,
Yeah.
wow, that's a great opinion, because
So
it gives us a lot more hope that
Yeah.
it can get back down.
Absolutely.
Because I thought that was a one-off thing personally, and I'm in the industry, so.
Yeah.
I
Now,
hope
will
it
we
happens.
get down into the 2s again? Those were very low rates.
Well, that's extreme.
Yeah, that's extreme. But should we get back down into the 4s and the 3s? I don't think that's. I think that's more likely. Absolutely.
So Vina, in our conversation earlier, I know we were talking about, should the buyers buy now? Should they buy later? And what I normally tell people is it really depends on their situation, because this is our market. We can explain where our market is, but every buyer has a different situation, right?
Yeah.
And as you know, like, if you're living in Vegas, you only have 2 real options, and maybe 3, where you have to own a home to live somewhere, you have to rent a home to live somewhere, or you have to sleep on someone's couch to live somewhere, right?
Yeah, so based on that, how are listings going right now?
Oh geez, I'll tell you what is a lot of realtors in Las Vegas, in the last few years, everybody's fighting over listings, right? And I think when you have a lengthier career in this industry, a lot of realtors forget about the time in 2000, our foreclosure time, 2009, 10, 11, where we struggled selling listings. And so we almost didn't want them because we put it in the market. We spent a lot of money trying to advertise it, but we're competing with all these discounted homes with foreclosures and short sales that we couldn't sell these homes. And I remember the pressures we would get from our owners breathing down our necks, like, why isn't my home selling? And I think we're kind of in that market temporarily today, where we have that pressure from owners expecting their home to be sold in 2 weeks, same as interest rates, because a few months ago, we would list a property and we would expect 5 to 15 offers in a weekend. Today we're in a completely different market. We're in a different market than we are from a month ago. So even if if you ask me, like, what market we're in now, I would tell you we're in a completely different market than June.
Mm-hmm.
And the good thing is that July is right around the corner from coming to an end, and we'll have the monthly statistics to analyze the difference between July and June. But what I do know to be true is that prices have dipped. It is correcting. We are in a shifting market, that is fact, and listings are harder to sell because buyers, not that they're not qualified, they're just not pulling the trigger right now based on the unknowns, and I get it. So I'll ask you about how you're dealing with your buyers in the field with some confidence concerns. But for our listings, it's getting harder right now until the buyers have confidence that it's the right time to buy again. And so when I consult buyers, we're talking about what's the opportunity cost for not buying, and it's usually renting.
Mm-hmm.
The issue with renting that a lot of people don't look deeply into is the fact that, number one, rent is 100% expense, whereas a mortgage, there's expenses in a mortgage, but a lot of it goes towards principal, which means that you're investing in your own property. But in the rental side, it's 100% expense, they're not getting that money back, and rents are going up dramatically every single year, and I don't think that's getting better. And with inflation going up, I think rent's gonna continue to climb. And with a shortage of inventory, I think rent's gonna continue to climb because people, in my opinion, will continue to move to Las Vegas. So, that's kind of the conversations we're having with our buyers and trying to explain to our owners, hey, there's a pause right now, but it's because the buyers aren't sure what to do. It's not like they're not there, and it's not like they're not moving here. We know they are. It's just a matter of what are they doing, where are they living, and I think they're still trying to figure that out. But as far as listings, we're sitting 20, 30 days on the market. We have a showing here and there, and our owners are calling us pretty much daily, like, hey, give me an update, what's new, and we can only give them what's going on, which is the facts, and then kind of educate them or re-educate people on where we are in the market and what we're doing as far as marketing strategies. Because as listing agents, I use the joke that I don't have that Harry Potter wand, the wand is really advertising and marketing. And what we do is we try to out-market and out-advertise your competition if you're selling, and get your best foot forward to showcase your home, thus get engagement, which leads to viewings, which leads to offers, which leads to sales. And so that's really what we can do to get offers on the table. And then once we get it, then we can kind of do our thing and negotiate and kind of show our stripes that way. But right now, it is not a one-off thing. This is the conversations we're having daily with our sellers, that this is an industry-related topic. And houses are sitting longer on the market than they did for the last 3 or 4 years, and we're not in the same market we were. And so I think education and doing things like this, correcting people's thinkings into just dealing with the actual facts, such as those interest rates and mortgage rates and what's happening, is so critical, because people are making emotional decisions based on what they see on the news. And what I see on the news is market crash, like housing crash, housing bubble, blah, 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 like inflation, historic numbers, and it's all gloom and doom. And I don't blame the sellers for getting a little antsy and emotional, and buyers for being confused. I know you're dealing with buyers, like how's that going for you? Are they like, I'm not sure what to do, or they still?
A lot of them are unsure what to do, and then I recently had a client that we had a lender that had to keep pushing back. We had to keep asking for extensions on it, but because of the market with sellers, the seller was really patient, so we extended 30 days just because they were so desperate to sell their home. So there's some good news for buyers in that aspect, because sellers really want to sell right now.
Yeah, as a professional, I like to give my consultations and give advice to people a lot of the time, and I stand corrected in certain areas, because what I thought would happen has not come to life as I thought it would. For example, if there's a bell curve of affordable homes, your average price point, and luxury homes, I thought it would be the heavy bell, the mountain of the curve, where we would be really affected. But what really shocked me is that even the affordable condos have been affected, and the luxury market has been affected. And I think it's just across the board, because for your condos, I think a lot of our investors are still on the sideline waiting to see more adjustments and hoping for adjustments. And on the luxury side, I think the luxury buyers, they have the ability to buy it anytime they want, but I think they're following the financial economy, which is leading to their real estate decisions. Whereas the place that I thought would get really corrected more than the two ends was our average price points, just shy of just at the 500,000 mark. But again, it's across the board. What you seeing on your side with loans and everything else?
Well, I think speaking to the luxury part of that, one of the charts that I look at, and I think I mentioned in a presentation the other day, was that the small business sentiment is at one of its lowest levels in the past 30 years. right now, and many of these luxury buyers are small business owners, and so they
are probably coming from California, Hawaii, and the big cities.
Yeah. So they're kind of looking at where things may be going over the next 12 to 18, 24 months for their businesses and everything else, and that could be what's going on with their their willingness to go out and purchase a luxury home. They may be looking at saying, interest rates have gone up, my business might run into some rockiness over the next next year or two here, and I'm not necessarily willing to extend myself on something like this for either a second home. Many people were purchasing second homes in this market, either real second homes or second homes that they could live in for at least long enough to be able to claim those primary homes for tax reasons. We saw a big influx of people moving into here from the high tax states. That was a real benefit to people moving in from California, from Hawaii. So I think some of that is slowing down simply because of the perceived economic conditions that we could be going into here. And small business owners are they sense that ahead of the average consumer.
The irony about this market is normally it's either a seller's market or a buyer's market, and one side is on the they have the happy face on, and the other side not so happy. Today it's both markets are unhappy, right? Because you have your sellers that they're not getting what they want based on what their expectations are, and the buyers are the interest rates aren't what.
So normally you have one side or the other going, okay, I'm going to take advantage of the situation. Right. So now you have the buyers saying, well, I don't necessarily want to, or I can't because rates have almost doubled during that time period. So the sellers are ready to sell. It's okay, and then the buyers are saying, well, maybe I should wait. So it is an odd time, but it's just a moment in time. When you go through these markets for economic cycle after economic cycle, you realize that they're just seasons, and we're in a season right now where we'll just work through it, and then we'll come out the other side, and things will change again, and then something will open up, something will change, and it will all be better again. It's just
I think
a few things just need to shift for things to change.
I think it's just human nature. As humans, I hear everyone saying I woulda, shoulda, coulda when things were good back then. Yeah. But when things were bad, nobody is saying I woulda, shoulda, coulda because they would have got themselves in trouble. Yeah. And so I think a lot of today's market, buyers and sellers are looking at yesterday and what could have happened. Maybe the peak of the market on selling and the low of the interest rates buying, rather than here's where I'm at today. Take the past away. Is it a good decision for me to sell or buy today? And I think what we try to do, and I think what would be a good recommendation for buyers and sellers, is to make today's decision based on tomorrow versus in the past, because the past doesn't really matter except for data. It's here's what I can get today, here's what I need today, and can I do better tomorrow, or am I going to do worse tomorrow, and that'll help me make my decision today.
Well, that's exactly right. I mean, if you look at from a buyer's perspective, if you were looking for a home all of last year, the year before, you couldn't, you were being outbid, you couldn't find homes. Now is a really good time moving forward to look and find the right home for you. Negotiate a good price, find the right home for you. You're not going to have the same competition you had before, and find that home because you're not married to that loan. And so if you can qualify for that home at an interest rate that is higher than it was last year, an interest rate in the mid to high fives, for example, and you can get that home, the chances are you're going to be able to refinance that home in the future here to a much lower rate, and then you're just going to end up with a much lower payment than you have now, and you're going to be in a really good position. You'll end up with a house that you want, that you didn't have to compete for, that you're not going to have to sacrifice things that you may have had to sacrifice last year because you were competing against 4 or 5 or 6 other families, and you just took what you could get. Now you have the opportunity to maybe choose.
Yeah, because in the past, you can tell us this. How many competitors and multiple offers you were against?
I had a client put an offer, and the listing agent emailed me back saying, "Oh, we have 40 other offers."
So in the past, you were settling with what you could get, especially in the affordable price
Yeah.
range more so, but they were settling.
You got it. So
Yeah,
that's the
yeah.
positive side of all this. You can get what you want now.
Yeah.
So, maybe your payment temporarily will be, higher than you want it to be, but you're gonna end up with the house you want, and your payment eventually will come back down.
Well, on the
Right.
buyer side, I'm sorry, we'll go right back, I promise.
Mhm.
But on the buyer side, like, well, I'll let you finish and then I'll come back, because I'm trying to articulate my thoughts here.
On a positive note for the buyer side, I do want to say that my last buyer was really happy because he felt like he had a lot of negotiating other powers
Yep.
and put in a lower offer, but it still came, like, the appraisals came under, but the seller was okay to match it. And on top of that, he got a lot back in the request for repairs because the seller really wanted to get rid of the home.
And another strategy for some of these people is if they're really concerned about their ability, long term to be able to afford the home, or they really want to just lock in a lower interest rate, they can ask for a seller paid seller contribution.
Let's get back to that.
Yeah.
Let's get back to that, because that's
Because it's a really wonderful way to go about it. And then, they say, well, what if I can't refinance or lower rate in the future? Okay, well then ask for it now.
Let's get back to that one, and I'm gonna try to simplify what that means in case anyone's confused on that.
Okay.
But just to finish that conversation about opportunity for buyers, like, yes, they get to pick their own property that they really love today versus settling for whatever they could get accepted. But the opportunities that have really opened up that I've been following is that opportunities have opened up for VA and FHA buyers who had to compete with cash. The opportunity has opened up for contingent on sale buyers, and like, sellers are starting to accept contingent on sale offers, so that's an opportunity that wasn't there a month or two ago. And then like, getting into negotiations like you talked about, and you talked about interest rate buy downs. Like, if you're worried about interest rates today, we'll probably do a whole segment on just how to do interest rate buy downs and get your seller to pay for it, or bear it into your loan itself, depending on I'll let Dax speak into that. But the point is that you can put money towards buying down your interest rate. So if you're worried about 6% today, Dax or any professional in the lending world can kind of do the math on X amount of money will buy your interest rate X amount of points down. And I know you showed us that example on that flyer you shared with me, where I think the loan amount was $490 and the interest rate was like 5.75, and with $10,000, which we would try to negotiate for the seller to pay for, would bring the interest rate down almost a point back to like 4.99 or something like that.
Yep.
And so if you're worried about interest rates, guys, there's opportunity out there for negotiation, especially with the sellers, like, really, like, how do I sell my home? And on the flip side, we're using these strategies for our sellers, offering the buyers, like, hey, why don't we offer X amount of money to buy down the buyer's interest rates, to give them confidence that if they're worried about interest rates, what if we said that you could get your interest, your mortgage, a point less than what you thought it would be today? Then would you be interested in buying our property? That type of strategies. So I think we should do a whole segment on just that strategy, because there's a lot more details to it, and it's not as simple as I just put it out there, because there are things that you got to look out for, such as appraisal value and allowable contributions to loans and stuff like that. But we'll get into all of the details.
But there's ways around the appraisal issue too that we can overcome very easily. So.
Well, there you go. The secret's gonna come.
You could implement that strategy, and you could still, even if the appraisal doesn't come in, you can still implement that strategy, and I can show you how to do it.
Cool. Well, there's a lot more we can talk about. I think we're gonna have to call it a day. We've been running for about 35 minutes now, and gonna let you guys take a break from all this brain damage we just did to you. Soon to come, we're gonna be probably talking about those interest rate buy downs. We're gonna do the housing update in detail, and then we'll kind of give you some strategies on how to deal with it from both sides of the spectrum, buyer or seller or renter. And hopefully you guys will have questions, reach out. And since we're on YouTube, I hope you like the video and click the subscribe button.
Yeah.
Is that how it goes?
Yeah.
YouTube rookies. And yeah, support the cause because we're gonna continue putting out good information. And here at Xpand Realty, our whole thing is about value and educating the consumer, not the sales pitch. So like we're trying to add value to buyers, sellers, renters, and everyone in the market, and let the people know what's really going on.